Welcome to the Invest Like a Boss podcast.
I'm Sam Marks.
And I'm Johnny FD. We're self-made entrepreneurs who invest our own money and use modern technology to invest like a boss.
Join us each week for exclusive interviews with our network of modern investors, business owners, and multimillionaires to discover new ways to invest our hard-earned cash. Hey everybody, welcome back to another episode of Invest Like a Boss. Today we have on another very special guest, William Bernstein.
Man, I really like this guy. This is episode 16, and Bill Bernstein is the man when it comes to putting together portfolios. His picks beat every single other portfolio out there, according to our last guest,
Meb Faber. Yeah, so this is a great episode to last week's with Meb Faber. So Meb actually went through at least a dozen different portfolios, and then, as Johnny said, the portfolio that he reviewed back until 1973 that did the best was developed by Bill in his book, The Intelligent Asset Allocator. If anyone hasn't read that, I highly recommend it. It's a great complement to the new Tony Robbins book that we often talk about, Money Master the Game.
Yeah, but what's really cool about this episode is how he talks about, even though he was number one, and it wasn't that he was just compared against a dozen other portfolios, he was compared against the other dozen best portfolios out there. So it's almost like saying he was compared against the other top 10 and he came up a winner. But what's really cool about it is in this episode, he talks about what he would do differently to make it even better. How he would, I guess, hindsight is 2020, but the history of the market, it repeats itself. And there's a big disclaimer that past performance does not equal future success. Right. But that is all we have really to go on if you really think about it.
Yeah, absolutely. And so Bill frankly says he wish he had written the book 50 years ago. And luckily for all of us, we can read the book now and learn from all of his knowledge. And he's written several best-selling books on finance and modern portfolio theory. But one of the things that we wanted to speak to him most was about lump sum investing versus dollar cost averaging. And I think this is relevant to a much broader, many more people than you would initially think, because it doesn't mean that you're just coming into $1 million and figuring out what to do with it. It might mean you have $5,000 or $50,000 that you saved up and you want to figure out, do I invest it all today, or should I invest this sum over the course of 6 months, 12 months, 18 months? So I think it's something extremely important for everyone to understand what the risks and rewards are of doing dollar cost averaging or just putting it all in the market at one time.
I love it. And on a side note, I'm happy to be back in person with my buddy Sam Marks.
That's right. You sound loud and clear. Yep. We're chatting to you from Burgas, Bulgaria. Didn't see this one coming on the list, but it's a great place. And we'll be doing another couple episodes while we're on the road on a trip up to the Ukraine.
Exciting things. We got a little suntan from the day. Had a couple Bulgarian and Czech beers. So get ready to rock and roll and grab your own beer.
Yeah. And everybody stay tuned after this episode. We're going to do a little recap of some of the key takeaways that we learned during this really, really great episode with Bill Bernstein.
And there were a ton of them. All right, guys, enjoy.
Hey, everybody. Welcome back to another episode of Invest Like a Boss. Today, we're joined with Bill Bernstein, who is a financial theorist, a neurologist, and has also written several best-selling books in the field of modern portfolio theory. Bill, thanks so much for coming on the show. We're really excited to have you.
My pleasure.
So Bill and I were catching up before the call, and you are a frequent traveler and used to reside, I'm not sure if you actually resided, but I've been up to Chiang Mai quite a bit.
Yeah, I mean, we're just tourists. Go there for a week every couple of years. Like the climate, it's nicer than Bangkok, and it certainly has good tourist infrastructure. It's just a great place to hang out.
Yeah, it really is. So there's a lot of us that spend a lot of time up there. Johnny and I my co-host, have spent a good part of the last 2 years there, and now we're kind of migrating a little bit towards Bangkok, just because it's a little bit more going on year round. So that's where I'm at now, and you're in, I guess, in the West Coast in Portland.
Yeah, Portland, Oregon. Yeah, Bangkok is such a vibrant, multicultural city. It's very much like London in that regard. I think.
Yeah. It's interesting. It's good to hear you say that, because so many people come in and they're here for 2 days and they don't really get to experience the real, the softer side of Bangkok. And it's good to hear, people at your level that enjoy the city. And I think it's becoming much more of a hub for professionals as well. versus just kind of tourists maybe in the past couple decades. So we're enjoying our time here. When's the next time you're planning to come out?
Oh, probably not until early 2018. This next year is pretty well spoken. The 2017 is pretty well spoken for us. Mm-hmm. So we'll probably come out the year after.
Oh, good. Well, hopefully we'll cross paths out here at some point. So it's really funny because when I found that you are actually a neurologist, I was thinking to myself, what a perfect compliment for someone who is giving investment advice and writing books on it, because that's certainly something I need, is someone who can calm my nervous system and tell me a better way to invest. So is that by just coincidence that you got into neurology and also finance, or was there a different path to that?
Well, the two are probably connected. I think that neurology probably attracts more analytical and quantitatively oriented people. Although, there are other medical specialties that do that as well. Particularly cardiology and nephrology, people who treat kidney diseases. That's also fairly mathematical and model based. So really what it boils down to, though, is I just have a scientific bent, and I tend to approach subjects quantitatively, and like everybody else who lives in the United States, I live in a country that really doesn't have a functioning social welfare system, so you have to save and invest for yourself. I approached it the way I thought anybody with scientific training would do, not necessarily medical neurological training, but just I wanted to make it evidence based, and it's possible to do that now, and that's what I did. I
like it. I just finished reading your book, The Intelligent Asset Allocator. I absolutely loved it. I wish I had read it when I was in college and first starting to dabble with investing. So I appreciate the book, and I would definitely recommend it to anybody out there who has not read it to read it. I actually listened to it on Audible, and I listened on 1.25 times speed. I got through it in like 4 hours and was immediately back to my drawing board of figuring out how to do things better. But
I wished I had written it, at age, when I was in college instead of at age 50.
Yeah, well, luckily for everyone out there that's just starting or in their 20s, there's so much good information out there, including this book, that helps you get a base for understanding a better way to invest. And I know you're a big proponent of modern portfolio theory. Can you let us know a little bit more, just in layman terms, what that exactly is?
Well, modern portfolio theory, if you will, is sort of the second leg of finance. The first leg of finance is the efficient market hypothesis, which basically says that 99% of people can't pick stocks, they can't time the market, and further, the people that look like they can do it are really more likely than not lucky than skillful. The second leg of that is what we're talking about here, which is modern portfolio theory, which is once you accept the efficient market hypothesis, then it really comes down to a question of what asset classes are you going to invest in, and in what proportion. And so, there's stocks, there's bonds among stocks, there's foreign stocks, emerging market stocks, there's other asset classes as well, real estate investment trusts, and maybe, if you're really a fanatic about asset classes, things like precious metals, equity, and petroleum stocks. And modern portfolio theory is the science, if you will, of how to combine all of those things into a portfolio, and how to measure their performance, and also what kind of returns and risks to expect when you do that sort of thing.
That's great. And so last week we actually had Meb Faber on the show. We just released that episode. It was awesome. And this is the type of thing that we were exploring. And what turned us initially onto this was Tony Robbins' new book, Money Master the Game. And we always say that there's a lot of opinions out there about it, but it was a good book for us because it kind of excited us about, in typical Tony Robbins fashion, about empowering you can do this yourself. You don't necessarily need an advisor. And I think this goes in line with a lot of things that you're teaching. And in the book, well, actually very coincidentally, when we were looking at the asset allocation models that Meb Faber was testing, yours ended up winning over the last 50 years that he did the tests. And I just want to highlight what that what the composition was of that. It was 25% US stocks, 25% small cap stocks, 25% international stocks, and 25% bonds. So we actually chatted briefly about this in last week's episode, but I just thought it was fantastic that you were coming on the show this week, and this was the best performing model that he had tested over the last, I guess it was since 1973.
Yeah, he was being very generous, because the portfolio that I recommended, which is really 50% U.S. stocks and 25% foreign stocks and 25% bonds, because it's U.S. large and U.S. small. Each of those got a quarter. But the simple reason why that portfolio did so well is not because I'm a genius, but because it had, of all the portfolios that were on that list, it simply had the highest stock exposure.
Right.
And so, yes, it got the highest return, but it also had the highest risk.
So if it was even more weighted in stocks, then would it be safe to assume that it could have even outperformed this model during that same time period?
Oh, sure. Yeah. If you dial up, if you just take for example, my allocation, or for that matter, any of the other allocations in the list that you're talking about, if you simply dialed on each of them, dialed the stock up or dialed the stock down, you would dial up the return or dial down the return. It's simply a function. Over the long run, stocks almost always beat bonds. And although funny thing is they haven't over the past 20, but there's a reason for that. But over the very long term, certainly 30, 40, 50 years, the more risk you take, the higher the return you get. The trick is so you might say to yourself, well, why aren't I investing 100% stocks? And the answer is that there aren't too many sentient beings in this quadrant of the galaxy who can tolerate an all-stock portfolio.
Yeah, so who can tolerate an all-stock portfolio? I guess my co-host, Johnny, he's probably a 10 out of 10 on the risk factor. But I guess in theory, the younger you are and the longer you have to invest, the more risk tolerant you should be. Is that kind of traditional thinking?
Yeah, it's basically falls right out of finance theory. And I don't want to get too much into the weeds in this, but academic finance people like to talk about how risky really are stocks. And there are a lot of, abstruse mathematical things you go through. And the orthodox answer is, yes, stocks they get more riskier with time. They really do. And there are a number of reasons why that is. But the key thing that no one ever asks is, how old is the investor? So if you're a young investor who is typically saving, and you've got this nice stream of savings that you're socking away into your retirement portfolio every year, that person should be invested 100% in stocks. And for that person, stocks aren't risky. In fact, that person should get down on their hands and knees and pray for an awful bull market that lasts for as long as he is accumulating those assets. And then he wants the bull market to take off when he retires. Whereas the exact opposite is true for a geezer like me, which is that, assuming that I have no more savings and I'm now living off of those savings, I'm not saving, I'm decumulating, I'm spending my savings. For a person like me, a bear market in stocks and being too heavily in stocks can be an absolute disaster,
right? Because
you combine, a bad bear market with say a burn rate of anything more than 4 or 5%, and throw in an illness, and you're toast within 10 or 15 years, and you may live another 15 years beyond that. So for old people, stocks are 3 Mile Island, Chernobyl toxic.
Gotcha. And so in your book, the Intelligent Asset Allocator, when you kind of present that portfolio, the 25% stocks, US, 25% small cap, 25% international stocks, and 25% bonds, you kind of give 3 levels of, I guess you could say, involvement, depending on how diversified within those asset classes you wanted to be. But for someone who just wanted to go out and buy these 4 asset classes, I guess you could just do that with 4 funds, right? Like the U.S. stocks could just be the S&P 500 and so on and so forth.
Yeah, exactly. You can do that particular portfolio for next to nothing in expenses. You can buy with ETFs, for example. Each of those asset classes for between 5 and 10/100%, 5 or 10 basis points.
Mm-hmm.
So you can buy that whole portfolio for a lot less than 0.1% per year in expenses, versus if you've got a stockbroker, if you've got a conventional financial advisor, you're going to be more in the 2%, 200 basis point range instead of the less than 10 basis point range. And that falls right to your bottom line, by paying the financial advisor or the stockbroker 2% per year, that's all lost to you. The odds that person will be able to beat the market over the long term and earn back that 200 basis points he's costing you, or zero.
Yeah, and that was one of the key takeaways that we had during Meb's conversation last week, was not to over obsess about the actual allocation, but just to make sure that you implement it in an extremely cost effective way.
Yeah, exactly. I mean, more important, and I would extend that another sentence or two out, which is you can if you want to obsess about your precise asset allocation,
mm-hmm.
but far more important than the precise allocation is how well you stick with it, and you're better off having a suboptimal asset allocation, say one that's less, heavily invested in stocks, that you can stick with, rather than an optimal allocation you can't stick with because it's too risky.
I like it. And so when you go into these asset classes, how many would you recommend to diversify across? So if you, at this level right now, there would just be 4. It'd be the U.S. stocks, small cap, international stocks, and bonds. Would you recommend going into, say, 2 or 3 additional levels of diversification within each of those allocations or each of those asset classes?
Yeah, there's something that's increasingly been known. I would go even simpler than that. Let's
mm-hmm.
start from the simplest portfolio, mm-hmm. which is what's called a 3-fund portfolio, mm-hmm. which is total U.S. stock, which has both large and small stocks, total international, which also has both large and small stocks, and then bonds. And so that's the simplest one to do. There's something that's actually even simpler than that, and is probably the best for most people, is if you've got a good target date fund, that is a target date fund that is fully indexed or fully passive and has very low expenses. Mm-hmm. For most people, that's even the best. So that's a 1-fund portfolio, if you will. The trick is you have to have a fund family that does that, and I know of only one, and I really shouldn't mention the name of it because the SEC might get upset at.
Okay.
Specific fund, but you probably know what the name of that fund company is, and you can even say it, and I wouldn't get into trouble. So that's so you can have a 1-fund portfolio, you can have a 2-fund portfolio using a total world stock market, mm-hmm. and a bond. I wouldn't recommend that because that's too foreign heavy. There's the 3-fund portfolio, there's the 4-fund portfolio that was the one that Ned Faber looked at that we were talking about mm-hmm. earlier. And then you can add in other asset classes. You can add in, for example, international small stocks with an index fund or an ETF that does that. You could add in real estate investment trusts. Mm-hmm. You could add in precious metals equity. By the way, if you buy precious metals equity, gold stocks, you better be very disciplined. You better have a very long time horizon, and you better be prepared for the fact that it's an asset class that can lose 75% of its value over a 3 or 4 year period, which is exactly what it did between 2011 and late 2015.
Right, and it's also kind of difficult to watch your stock accounts rise, as that one would probably be going in the other direction, right? It just makes you want to get rid of it.
Yeah, exactly. Now, that's the beauty, though, of investing passively, that is indexing, if you will, which is that when an asset class does really poorly, it's generally not a bad idea to buy more of it.
Yeah.
You can rebalance back to your policy. So if say, a given asset class is 10% of your overall portfolio, and it does really lousy, well, it's going to go to 7 or 8% of your portfolio, and that's the point where you have to buy more to top up, again, the 10%. And there's some people who would even double down and go to, 11 or 12 or 13%. So that's the really beautiful thing, is that when an asset class does really poorly, that's often a really good reason to buy it, because it means it's gotten a lot cheaper. Okay.
Yeah.
And, whereas when you're buying actively managed funds, when you're buying funds where people are picking stocks and it does lousy, you really have no way of knowing whether you just picked a lousy manager or whether you've picked a lousy asset class. If you picked a lousy manager, you should fire her. Okay. If you've picked a lousy asset class, you should buy more.
I like
all right,
it.
because it's gotten cheaper. So it's gotten cheaper, and you're buying lower, and its eventual returns should be higher. I mean, at least in a statistical sense, that doesn't happen 100% out of the time. But if it happens 6 out of 10 times, you've won the game.
Yeah. I really like what you said about how just starting simple and being able to add lots of, add funds as you go along. And it's really funny because Johnny's, my co-host, he's got a Vanguard portfolio and he's only got one fund in it. It's VTI, which I think is just total stock market index. And I started with 3 funds, I believe, that's pretty similar to what you've laid out. And since then, I've picked up probably another 20 because every time I look at a fund, I'm like, oh, this makes sense in my portfolio. This makes sense in my portfolio. So I just keep adding them. And I don't think that's necessarily the best strategy, but it's interesting that Johnny and I can compare our accounts at any given point and see how they're performing against each other, where his is fully in equities and just one singular fund, and mine is diversified across 20 different asset classes, or not asset classes, but different funds within asset classes. So very interesting to be able to compare them side by side. And Bill, I wanted to jump into, I know you have plans and stuff, but one of the things that really turned me on to your research and supporting material was I came across one of your articles about a year and a half ago that was on lump sum investing versus dollar cost average. And I think there was also a component of value cost average in there. And when we decided to start the podcast, this was one of the main reasons why we decided, because we found information like this and just realized what a gold mine it is to people of our age that are just getting started in the investing world. And Johnny and I come from basically 2 different paths. Johnny's a kind of a passive income expert. So he's got 12 to 15 different revenue streams that he's built up himself online over the last 4 or 5 years. I'm the absolute opposite. I went all in on a business and had a good outcome and had a windfall, but I have 0 passive income. So I'm basically the lump sum investor, where Johnny is, just because of his revenue streams, is now a dollar cost average investor. But specifically about someone who, let's say they have just come into money or they've saved money and now they're ready. They've read your books. They've got their asset allocation in mind. What is the advantage of doing a dollar cost average approach versus just putting it all in the market in a lump sum investment and hoping that the market goes up from that point forward?
Well, that's a really good question. It's a difficult question to answer. The way to do it is to think about it as sort of a thought experiment, which is that let's take, you versus Johnny, and let's just say, for the sake of argument, that Johnny got $1 million 10 years ago, all right, and he had to invest it. But you didn't get your $1 million all at once. You got your $1 million, but you got it over 10 years, $100,000 every year, all right? If Johnny put that $1 million into the market, all right, he had $10 million years. He had $10 million. He had $1 million times 10 years, okay? So that's $10 million hyphen years, okay? Sort of like man years, all right? Whereas you've only got 5, okay? Because you built up slowly. Your average portfolio size was more or less $500,000. So you only had $5 million years in the market. So therefore, Johnny's portfolio should, in most circumstances, have had a higher return, simply because he had more dollars in the market over on average than you did. All right? And that's the difference between lump summing and dollar cost averaging. All right? Most of the time, lump summing beats dollar cost averaging because you've got more dollar years in the market. All right? And it's higher return, but it's also higher risk. Okay? Because if you have 10 bad years, if you've got horrible returns for those bad years, Johnny's going to do terrible. All right? And the easiest way to think about it is, let's assume that you invested from, say, 2000 to 2010. All right? 2000 was the top of the market. And if you invested lump sum, if you would put $1 million in the market at 2000, by the time 2010 rolled around, you'd be lucky if you broke even. All right? Whereas if you put $100,000 in every single year, you'd have come out ahead. Okay? Because you would have invested through 2 bear markets. All right? And you would have bought low. So in that instance, the dollar cost averaging person does better. Now, most of the time that doesn't happen. Okay, most of the time you don't invest through two bear markets. All right, so it's apples and oranges. On average, lump sum investing has a higher return because it has higher risk.
Right.
All right. Now, there's another aspect to it. So in that respect, lump sum averaging is optimal, and most of the time, dollar cost averaging is suboptimal. But remember what I said earlier, that a suboptimal strategy that you can live with is better than an optimal strategy you can't.
Very good advice, yeah.
Yeah. So there's nothing wrong. To me, dollar cost averaging is a wonderful crutch. And it's a wonderful psychological crutch. And as Yogi Berra very famously said, 90% of this game is half mental. And that's true of finance as well. If you can win the psychological game, then you've won the game. And dollar cost averaging is not a bad way to do that. Now, having also said that, most people are going to wind up dollar cost averaging anyway because they're not going to have, $1 million or $2 or $5 million dropped on them. They're going to save that money over many, many years in drips and drabs, and so really, by default, they're dollar cost averaging. There's no choice there.
Right. It's like if you had $100,000 and you invest that in the market, but then each month maybe you're putting in another $2,000. That's still dollar cost averaging it. You're just putting a lot of weight up front.
Exactly.
So this article it's one of my favorite articles I've ever written in finance. I kind of took it. My takeaway was that essentially by dollar cost averaging, you're buying insurance, and that insurance premium may cost you, say, low 1%, like 1 to 1.5%, which that would be the lack of performance on average that you would get by doing dollar cost averaging. Now, there's the dollar cost averaging for different periods of time, which are also covered in the article. There's, say, 6 months, there's 12 months, there's 18 months, 24 months, 36 months. And the longer you dollar cost average, the more, it's essentially like the more insurance you have, but also the more you're likely to hinder your own performance. Is that correct?
Yeah, that's right. That's right. Or it's that's one way. It's a good way of putting it. Another way of putting it is simply saying that by dollar cost averaging, you've got a lower average equity exposure. You don't have a 100% stock portfolio. You've got a 50-50 portfolio when you dollar cost average.
Yep, or
over time.
Yeah. So the major takeaway, which is also the title of the article, is do not dollar cost average for more than 12 months. And that's actually...
You realize, by the way, I didn't write that article. That article was wrten by a guy by the name of Bill Jones.
Yeah.
who's a mathematician. So that's not my title, but I thought it was a fine piece. So, I agreed to put it on my website.
Yeah. And so, efficient frontier. So we'll leave a link to this in the show notes. Yeah. So this is a strategy that I did. So I opened a Vanguard account. I took a lump sum and I applied this methodology to it, where I got my asset allocation and then I set up the buys every month into these funds. The trouble that I've been having is the market's been, of course, pretty hectic. There was the Brexit, and so the Brexit happened, the market tanked, and then almost recovered in 4 days. And I missed that. I wanted to go in and buy then, but my buys were set up. And then now the market's been doing pretty well. And, so now I'm like, well, should I just put the rest in now? Because I don't want to miss the upside. So it goes back to what you said about the discipline and kind of sticking with a strategy, right?
Yeah. What you're trying to insure against is not Brexit, which was over in a matter of days.
Right.
What you're trying to insure against, what you're buying insurance against, is a horrible market like from 2007 to early 2009. You had plenty of opportunities. The opportunities to buy low then didn't last for 3 days. They lasted for a year and a half.
Yeah, very good point. It's very difficult now. It's so easy to buy and sell stocks. It's like you turn on the news, you see a geopolitical event, and you're like, it's like, I think that's almost some of the value that you get with having an advisor or someone that manages it for you, is it kind of keeps you a hand's length away from touching things. So certainly someone like me and Johnny, who we're on our computers all day long, and one click away from our Vanguard and E-Trade accounts, it's very difficult to not be active and to stick with something. So
that's where knowledge of financial history comes in. You can be the most brilliant computational finance person in the world, and you'll still have your head handed to you if you don't know enough financial history. And what financial history and financial theory tells you about macroeconomics is the two are almost inversely related, because you are paid to bear risk. And the greater the risk you are bearing, the greater the return you have to get in order to make that investment. So when things look the worst, theoretically, that's when you should be buying. When things look the best, that's the time not to be buying, because the risks don't look high, so you're not going to get paid a lot of return. And in fact, when you look at financial history, that's what you learn. The very best times to buy stocks were 1932, 1982, March of 2009, all times when it looked like we were going down the tubes. It looked like the end of the world as we know it. I mean, I lived through 1982. That looked like the end of the world as we knew it in stocks. Same thing with 2000, early 2009. And what we told our clients then when we were investing, putting more money into the market in late 2008 and 2009, was the odds are 80% that we're going to make you a lot of money with these purchases. But there's a 20% chance we're going over the waterfall.
And that 20% chance would also mean that it's probably some type of apocalyptic event, right?
Well, but 2008, 2009 could have evolved into an apocalyptic event. I think we came very close.
Wow.
And so you get paid to bear that risk. And people also make the mistake of correlating macroeconomics and good economics with good returns. Well, all you have to do to disabuse yourself of that is to look at China. All right, China has had near 10% GDP growth over the past 25 years. Its stock returns have actually been negative in real dollars.
Wow.
All right, up pretty close to zero in nominal dollars, before inflation dollars, and with after inflation dollars, it's been strongly negative. So there's almost no correlation between economic growth and stock returns. And this is one thing that drives me nuts. You hear market strategists talk about the wonderful economic prospects in this country or that country, and I think to myself, yeah, that's a good reason not to own them.
That's so interesting. And I guess that also plays into not being specific country bias, like home country bias, or if you think China's market economy is going to be strong, it doesn't necessarily mean you should go out and buy their market index, because there might not be correlation there.
Yeah, exactly. The bottom line is that you should really just turn off the news. When it comes to China, what I'm fond of saying is that a country that doesn't protect its children from lead-contaminated toys is probably not going to protect the minority interests of foreign shareholders terribly well either.
Right. Yeah, definitely. I bought a bunch of RMB at the absolute worst day when the exchange rate was 5.95. Put it into fixed foreign currency accounts or whatever, making 1.8%. And since then it's devalued. I think it's almost 20%. It's like 6.7 on the dollar now. I bought it at 5.95. So good timing on my part.
There you go.
So Bill, I want to be very conscious of your time, and we really appreciate you coming on. I just had a couple of last questions to kind of summarize for some of our listeners. You mentioned earlier you wish you had written one of your books 50 years ago. What advice would you give to people now, or what do you wish you had when you were younger that you could apply to investing strategy?
Well, that's two separate questions. I mean, I'll answer the second question first. What I wished I had known 40 or 50 years ago was how low the risk was of being fully invested in stocks as part of a periodic savings program. So, I set up my first IRA, I think, in 1978, and I wished I had known back then that investing 100% in stocks when you're young is really not that risky, because you're investing every year, and eventually you'll catch the bottom of the market. All right. Mm-hmm. And had I done that, I would have caught the bottom of the market in 1981, 1982. And so that was the first thing I wished I had known. The advice that I give to young people is really pretty simple, and it's kind of curmudgeonly. But we live in this very corrosive consumer-oriented society where we're constantly being told that we are what we wear, we are what we drive, we are what we live in. And if you seek happiness in material goods, if you think that stuff is going to make you happy, you're going to be miserable. Money doesn't buy stuff. Money buys time, and it buys autonomy. Money buys you the time to do what you really feel like doing, what your passions are. And the worst way you can possibly spend your life is in a job you can't stand because you got to make BMW payments, because the BMW will not, the joy of owning a BMW doesn't last that long. Ignore the blandishments of our consumer society. Madison Avenue sells you nothing but discontent, and save as much money as you can, live as simply as you can. And then when you get to be an old geezer like me and you've got adequate money saved up, you will kiss yourself every time you can finally check into a nice hotel.
Perhaps the best investing advice anyone will ever give you, and for life itself. And that's one of the reasons that we like Chiang Mai so much, is that you go up there with essentially a small bag of clothes, and that's all you need. You rent a moped, you walk everywhere. No one's got fancy or flashy things. It's really difficult to spend more than $2,500 in a month, and that's living very well, eating out 3 meals a day. So it's a great place to remind you that you don't need all that material stuff that you're absorbed with when you step back into, the Western markets. So great advice. Really appreciate that. We're going to leave links to all of your books. I can't wait to listen and to read the other ones that you've put out there. This call has been tremendously insightful, and we really appreciate you coming on the show, and hope to catch up again soon and potentially do even a follow-up with you. If you're ever over in Chiang Mai, we'll be happy to host you or meet you anywhere that you are.
Okay, very good. Well, it's been my pleasure.
All right. Thanks a lot, Bill. Everyone else, stay tuned to another episode of Invest Like a Boss next week.
Man, that was such a good episode. Bill's such a smart guy, and I've learned a ton. And one of the biggest takeaways isn't even the math or the strategy. It's the emotion and the logic behind it. When he said that the best strategy is one that you can live with, not necessarily, anything else, the one that you can actually implement and continue living with, that really is the key.
Mm-hmm. Yeah, absolutely. And I think it's really cool that Bill is also a neurologist. It's just a perfect complement to being an investment advisor or an investment or a financial theorist, understanding how emotions play into investing. And I think the other big takeaway for me was going into the lump sum versus dollar cost averaging, and it is the title of one of the articles that he published on The Efficient Frontier. We'll make sure to leave that link. Please read it if you haven't already. It's critical knowledge for anyone who's investing, is that you shouldn't dollar cost average for more than 12 months. So let's just say you have $10,000, you want to put it into the market. Now you can use a little bit of discretion. Maybe the market's off its highs 20%. It seems like it's a good time to put it all in, or maybe the market's at its highs and you're a little bit scared to put it all in. But the point is, it doesn't make much sense statistically and mathematically to dollar cost average for more than 12 months, because chances are you're just going to be hurting your performance. So if you want a dollar cost average, statistically, it makes sense to do it from 6 to 12 months. And you have to look at it as essentially paying for an insurance premium. And for that insurance, you take a risk of not getting as much of a return, but you also cover your downside a little bit. So some great takeaways from this episode.
Yeah, I really enjoyed that. So if you guys are in the same situation that Sam was in a few years ago, where you got a big lump sum of money, either through selling a business, through inheritance, lottery winning, whatever it is, you might not want to put all of it in that very first day, because you might just have bad timing with the market. It might be a bit higher than normal. But Bill really broke it down where it does not make sense if you just hold on to it and put in a couple grand a month for the next 5 years, because you're missing out on potential returns. And that's actually one thing that I'm focused on personally, where I haven't been spending any money for the last couple of years, and I just been making money, and I haven't really started investing that much until just a few months ago, when really right before this podcast came out. So now I'm actually trying to play catch up. So I'm actually putting more money into investments now than I will maybe in the future. So every month I'm excited about putting my $3,000 into Vanguard, into index funds, but I'm also putting 10 grand into things like Pure Street, which we talked about, and the things that we're super excited about.
Yeah. So I think this article of dollar cost averaging versus lump sum investing, it's really relevant to anybody because it doesn't necessarily mean that it's $1 million tomorrow that you have to figure out what to do with. You might get a little bonus from your paycheck at the end of the year and have 10 grand, and then you have another 2 grand every month that you want to invest. And you just need to figure out your own strategy. So do the research, make your own decisions, and put together a strategy that works for you. And hopefully it's backed by some statistics and mathematics. And for anyone out there that hasn't read Bill's book, please listen to it. I listened to it on Audible. It took 4 hours, and it's a tremendous gem of learning based on all of Bill's experience and knowledge over his lifetime and what he's found to work.
I love it, buddy. So I hope you enjoyed this episode. Want to give a quick shout out to the latest reviews of Invest Like a Boss. I really enjoyed the one today. Sam, who is it by?
Yeah, it's by Dong from the USA. And they say, I love this podcast. The hosts are like you and me trying to figure it out where to invest their hard-earned money, but they have the benefit of being able to speak with gurus in the investment world, then sharing it with all the listeners. And Dong, that's exactly what we're trying to do and figuring out for ourselves and hopefully helping you guys figure out some of your own decisions along the way.
Awesome. So stay tuned. Keep leaving these awesome 5-star iTunes reviews, and we will see you next week. Bye-bye. Thanks for listening to the Invest Like a Boss podcast. Join our mailing list at investlikeaboss.com to get exclusive access to our insider investment portfolios and our private members forum.
If you enjoyed this episode, please subscribe on iTunes or your favorite podcast app. Tell your friends and leave us a review in the iTunes store. It helps more than you know. See you guys next week.